Hello and welcome to a discussion on how to account for bad debt expense. The previous videos discussed the concepts associated with bad debt expense. This video will focus on recording journal entries and reporting bad debt expense. After viewing this video, you'll be able to record the 4 common transactions related to accounts receivable, estimate and record bad debt expense using the percent of sales income statement approach, and estimate and record bad debt expense using the percent of accounts receivable and the aging balance sheet approach. There are 4 main transactions that are related to accounts receivable. A sale on credit creates and increases accounts receivable. Hopefully the customer pays and cash is exchanged for the accounts receivable. However, all customers do not pay everything owed, and an estimate of bad debt expense must be recorded in the period of the sale. Later, in a future period, the company will be able to determine exactly who won't pay and how much will not be collected, and the accounts identified are written off. Write-offs can occur as much as 2 years or more after the initial sale. The sale on credit is recorded with an increase in accounts receivable. When the customer pays, accounts receivable is reduced. The estimated bad debt expense for the period can increase or decrease the allowance account. The direction depends on the amount of prior estimates compared to the write-offs that followed. A write-off reduces both the accounts receivable and the allowance account and has no impact on net accounts receivable. The 4 transactions are reported on the balance sheet as accounts receivable less the allowance for uncollectible accounts. The income statement reports the original sale and the estimated bad debt expense in the same period as the sale. It is very important for you to know how the accounts receivable account changes. Credit sales increase accounts receivable, and customer collections and write-offs decrease accounts receivable. The beginning balance is always the prior year ending balance. Make sure you memorize what transactions increase or decrease accounts receivable. It is equally important for you to remember what transactions change the allowance for uncollectible accounts. The beginning balance consists of estimates made in prior periods. Write-offs then reduce the allowance. Remember that the allowance account represents what you don't know who will not pay. When you find out who will not pay, the amount must come out of the I don't know account. The unadjusted balance represents the amount left for future accounts that are not expected to be collected. The ending balance must be the current estimate of uncollectible amounts at the end of the period. The bad debt expense is the difference in what is left from prior periods and the current period estimate. In other words, the bad debt expense adds or subtracts an amount to adjust the current estimate of uncollectible accounts. Bad debt expense is a credit to the allowance account when uncollectible accounts increase. Bad debt expense is a debit to the allowance account when the company has overestimated bad debt expense in prior periods, and now the company must reduce the estimates in the current period. Let's review the 2 main approaches to estimating bad debt expense. The percent of sales approach matches the bad debt expense associated only with the current period sales to follow the matching principle. The percent of accounts receivable approach reduces accounts receivable by the estimated uncollectible amount to report the probable future economic benefit of the accounts receivable on the balance sheet. The percent of sales approach computes the amount of estimated bad debt expense related to current period sales only. The computed amount is recorded as bad debt expense and an increase in the allowance account that represents amounts not expected to be collected. There is no consideration of prior period estimates. The percent of accounts receivable approach uses the historical percent of accounts receivable that is not expected to be collected to estimate the future amount of accounts receivable. This method uses either the total amount of accounts receivable or the aging report of categories of length of time past due. Please review the previous video if you need a more detailed explanation. An amount that was previously written off may be collected from a customer in a later period. When collection occurs, the journal entry previously recorded is reversed, and the payment on the account is recorded in the current period. Please take a moment to read through this example. Notice the information that is in bold. This is the information that is required to record transactions related to accounts receivable and bad debt expense. You may want to write down the key information. Three transactions are recorded as they occur: the sale on account, the collection from customers, and the customers that are identified as not going to pay are written off. These amounts are given in the example. At the end of the period, the adjusting entry to record bad debt expense must be made. Let's first record the estimated bad debt expense using only the percent of sales method. The total current period sales amount is multiplied by the percent of sales that has historically proven uncollectible to get a bad debt expense related only to the current period sales. The computed amount is recorded as bad debt expense, and the allowance account increases to reflect the additional amount that is not expected to be collected. Next, record the estimated bad debt expense using only the percent of accounts receivable aging method. Each category of the aging is multiplied by the percent that is proven to be historically uncollectible to get the estimate of the amount not expected to be collected. The amounts are totaled, and the total must be the balance in the allowance for uncollectible accounts reported on the balance sheet. The bad debt expense for the current period will be the difference in the unadjusted balance and the current estimate of amounts that won't be collected. This can be computed using the T account for the allowance account. Begin with the beginning balance and subtract the write-offs that occurred during the period to get the unadjusted balance of $21,000. The current estimate of total uncollectible accounts of $95,000 is then compared to the unadjusted balance, and the difference is the bad debt expense. Under this approach, bad debt expense can either be a debit or a credit depending on the amount of the prior period estimates. Now let's estimate bad debt expense using both approaches. The percent of sales approach is used during the period, and the percent of accounts receivable aging approach is used at the end of the period, before presenting financial statements outside the company. The company used the percent of sales method during the year and recorded the estimated amount computed for each month using the percent of sales approach. This amount was $87,500 total. The accountant increased the allowance account at the end of each month using the percent of sales method, and write-offs decreased the account. The accountant now uses the aging report at the end of the period to estimate the total amount of uncollectible accounts, resulting in an estimated uncollectible amount of $95,000. The total estimated uncollectible of $95,000 must be the ending balance of the allowance account. The current unadjusted balance of $108,500 is $13,500 higher than the current estimate. Bad debt expense in the allowance account is reduced because the accountant overestimated bad debt expense before the end of the year. The total bad debt expense reported on this income statement is $74,000. The two entries are combined to get the final balance of $74,000. $87,500 was recorded during the year using the percent of sales method, less the adjustment of $13,500 at the end of the year using the percent of accounts receivable aging method, gives the total of $74,000. After viewing this video, you should be able to record the 4 common transactions related to accounts receivable. You should be able to estimate and record bad debt expense using the percent of sales or the income statement approach, and estimate and record bad debt expense using the percent of accounts receivable, or in aging, which is the balance sheet approach. Please go to StudyMyAccounting.com and work through practices you learned for examples of how to record all the transactions related to accounts receivable. Then work the practice test. Please write out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is very much appreciated.